Peter Rose, Longwood Currency Trading. Thoughts on large account risk management. If you don't understand the difference in how someone with a large account approaches risk management, that may be a little bit differently than what you're doing at the 4 and low 5-figure account level, you may get confused as to what you should be doing. And so I'd like to try to clear some of that up. I'm outside today, not for long because it's cold again. I think it was the last video I did, or maybe the one before that. It was, I was out here and I showed you the leaves off the trees and all that stuff, and stick season was here. And now we're outside and we had our first snow last night. This is the 18th of November, actually, of 2022. And so there you have it, snow on the ground. That calls for coffee. Very cold. And this is pretty hot. Nice combination for a, well, we're in winter, I guess. Once it starts to snow and we're right before Thanksgiving, you're getting pretty close to winter. When are you pretty close to disaster? When you don't follow your trading plan. And what's your trading plan based on? It's based on risk management. Now, in the beginning of your trading, when you're working with 4 and low 5-figure account balances, you're doing very simple, basic trading because you're trying to protect that account, because you don't have the money behind you in order maybe to replace that money, or you're going to constantly be reloading to bring it up to a balance where you can start making some money that would begin to indicate that you're in control of your trading plan and your win to loss ratio, your average win value, your per trade expectation value, and your overall percentage per trade percentage gain. Those metrics kind of show you where you're at. They're like the tracks that you leave. It shows you where you've been. And if you're careful in your trading and consistent, then those tracks pretty much are like a moving average line. They'll move yourself a long-term moving average. You can kind of figure that that's going to propagate through for a longer period of time than if you're on a short-term moving average. Statistically, if you take 10 trades and develop those metrics, you're not going to be as convinced in your ability as you would be if you had 200 good solid trades behind you. From a statistical standpoint, anything less than 100 trades is really not statistically secure. And certainly if you're just learning your skill sets, you may spend 100 or 200 trades just getting consistent, and so you wouldn't have good metrics. The metrics don't create your ability. You have to create the ability that then is reflected in the metrics. So it's kind of a catch-22 thing, and this is a risk management we're talking about. So it's kind of a catch-22 thing. How do you know if you're doing well if you don't have enough sample size in order to get decent statistics? And I'll tell you, look at your bank account. If it's going down, you're not trading well. That doesn't mean you can't have losses. And here's the first divergent in the smaller account size trading and the larger account size trading is the losses. When you're trading a small account, and I don't mean to be negative about it, but low 5-figure account is a small account. You get up into the $30,000 level. Now you're beginning to broach yourself into a larger account. But regardless of that, and if you've seen a lot of the videos that I've done, then you know why that differential, I'm drawing that differential at about that $30,000 level, or whatever you need to trade at a reasonable margin, 3 full lots. I don't even want to talk to you if you're trading at 200 or 100 to 1. It just doesn't, you won't get good metrics if you're basing them on volatile leverage, because it's not a good reflection of your average win value or your wins and losses and all that stuff, just because of the volatility. It doesn't mean you can't learn to trade. I know some very, very good traders that trade 200 to 1, and their losses are horrendous, of course, but their gains are 5 bangers, 10 bangers, over and above that. So everything is relative, but it's only relative if you know what you're doing. Otherwise, you're just an armchair talker. You can't make the conclusions and the determinations of your risk management success as a small account trader, because if you're trading 1 full lot at $10 a lot and you lose 50 pips, you've lost $500, and that's going to sting. But in the big picture of your life, $500 is not a lot of money. I mean, let's be serious about it. You're going to go buy a flat screen TV for $500. Come on. Soon I go out to dinner, we'll drop a couple of $100. So in the big picture of life, $500 is not a lot of money. If you have a $10,000 account and you drop $500, that's significant. But because it's not significant in your life, you will cast it off. You take that same scenario with a larger account where you're trading 10 lots, and all of a sudden that $500 loss becomes $5,000, and not only is that a big hit as far as your bank size, but it's a big life dollar hit. And that's where I get a lot of blowback from folks that are watching my channel here and trading, you know, mini lots, or they're just getting into trading and they're trying to talk to me about the theory of risk management and all the shit that they're going to do and all this other kind of crap. And I try to be patient with you when you do that, but you really are talking in a vacuum. Because until you have had a trade where you've lost or have running negative balances of $5,000, $10,000, $15,000, you have no idea of whether you're in control of your emotional state. Sure, it's easy to trade a couple of mini accounts and lose $30, $50 and think nothing of it, but it's an enormous percentage hit against that bank. But it's only a pizza. And so you think you've got it licked, and you're going to try to tell somebody like me how I should be doing things, or how things go together, and making pompous statements about trading the currency markets. You probably will never get to the point where you will be experiencing those $5,000 and $10,000 or $20,000 running balance losses, because you will have long ago, before that, lost the money that you do have and have decided that you'll go trade crypto because that's how you make money, not in currencies, or you can trade penny stocks or whatever. Trading currencies is the easiest of the investment or trading vehicles that are available to us. And yet, because of that ease of entry, the margin and the leverage, you don't treat it with respect. And that's where the risk management comes in. And that's why when I talk with people about working with them, and I don't work with many people, I try to get a sense of where you're at as a person and what you're going to be doing with your risk management and what your opinions are of you in regard to the market. And if you aren't willing to listen to some really basic guidelines, then I tend not to, I can't help that. And you know, I haven't had anybody like that recently, but I've had plenty of folks that have debated me about some of the things that I've tried to help them with in their own trading, and we don't hear from them too much after that because they're not successful. Or they continue to trade in a demo account and philosophize about how things should go together. I never did that when I started trading. I had 40 years of real estate experience. You put your money on the table, you buy the building, and you go for it. Now, when I got into currency trading, the risk management is a little bit different. Well, it's greatly different. It cost me $50,000 to learn the differential between risk management in currencies and in something like real estate. It has to do with the timing, right? And it has to do with loss mitigation. When I'm talking on these videos, I'm trying to address the needs of folks that are in the 21 to 34-year-old age group, because you've got time on your side to learn this stuff. You never have to work a day in your life after you get these skills down. So it's that age group that has time. But there's also that wonderful group at the 40, 50. I didn't start currencies until I was in my 60s. That age group where you've got all this life experience, and if I say something to folks in this age group, they go, oh shit, really? That's the way it is? Yeah, let me do some reading, let me do some studying, I can figure that out. Stuff. And they have a little bit better appreciation for how you're going to manage your money when you have those smaller account sizes versus what you're going to have to do when you have a larger account. So when I'm doing these videos, I'm addressing that 31 or that 21 to 34-year-old age group, but particularly those in that 4-figure to low 5-figure account size, because you're just in that process of getting all this stuff together and you're experimenting and you've got time to do that. And so it's really exciting to work with you, and I get these emails that are just really enthusiastic about what you need to do. And a lot of the time, and I don't have anybody taking courses now or anything from me because you don't need it. You've got that experience, you've done that work, and so I get an email and they say, well, these are the issues that I'm running into, blah, 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 blah. And I go, oh, okay, well, why don't you try this, and try that. Oh, yeah, I've read that. Well, of course you've read it. I'm not telling you anything that isn't out there already. All I can do is present it in a logical and reasonable order for you so that you can see the consistency of it. It's like saying, well, let's go walk through the woods. And you go, I can walk through the woods, and you go charging in the woods. Well, you bump into trees and you run into a bear or some shit like that. All I can do is say, well, look, here's a path through the woods, so you're not going to trip yourself, and dangle this little bell as you go along, so you let the bears know that you're coming, and they'll get out of the way. I mean, that's what a mentor or a coach does. I mean, I think a lot of the opinionated people that I run into have been so overpowered in the past by belligerent, strong-willed people telling them what to do in their job, or holding them back from what they feel their expectations are, that they become not depressed, but aggressive in their views of how life has treated them. And you can't do that when you trade currencies, because the currency market is far bigger than any of us and any of the large institutional traders. It's $6.6 trillion. and it'll be pushing 7 trillion, and it's going to continue to grow as international commerce increases. The retail market of that was 15%. I can't imagine that the retail market now is 15% of 6.6 trillion. I don't know what that market is. It would be interesting. If somebody knows that, let me know. 2022. But that was the statistic back when the market, I started looking at these markets in 2007 when it was a $3 trillion a day market, and now it's $6.6 trillion a day. So at that point, there was about 15% of the market was the retail trader. So even if the retail market has expanded with the commercial market, and I'm not sure that that is possible because of the dollar values that these corporations are throwing around to do these large airplane purchase deals, engine purchases, grain purchase, and all the other stuff that they have to finance. You can be in the futures market doing this stuff, but you got to be in the currency that the other country wants, right? So you're always going to have currency trading, and it's going to get larger and larger as there's more interconnectedness between the different countries, whether it's from a food product standpoint or a manufacturing standpoint. What doesn't change as us, as individual retail traders, how we manage our money. And managing the money is different than managing your trading position. Risk management of your money is different than risk management of your trading. I did a video on that a long time ago, I think back in 2020, in trying to look at the differences in the markets. This video is dealing with the specifics of there are differences between trading in risk management and trading the small account size, the 4-figure to low 5-figure account sizes, with that when you're trading, $50,000, $100,000 dollar accounts, or trading, get up into trading 15 or 20 lots. My experience, and the reason you should be listening to me, is that in 2022, in 2021, a couple of years before that, I had lost $40,000 and had to regroup and rethink, figured things out. I had $5,000 left in my account. I doubled that in about 4.5 months. I said, okay, I got this. But not only did I have that, but I also was able, in a very short period of time, to construct the path that I was going to need to go on in order to ensure that there weren't going to be any more $40,000 losses when all I had in my account was $40,000. If you lose $40,000 and you have $300,000 in your account, it's a big hit, but it isn't catastrophic like having $40,000, or at the time, $50,000 in my, $45,000 in my account, and I lost $40,000 of it. But I gave it a try. I went out and tried it. I realized that I had wasted my time in the demo accounts. I had wasted my time listening to all these people with this ridiculous advice. Don't risk more than 1% on the trade. Don't do this, don't do this, don't do that, don't do that. No, that's how you protect your money. It's not how you make your money or learn how to trade to make a lot of money when you have a lot of money. What good is it in having a lot of money if you're not going to put it at risk to make a lot of money? How do you think you're going to make a lot of money? If you had a $200,000 account, you're going to risk 1% of it. How are you going to make a lot of money? How are you going to do that? And look, if you want to pay for your light bill, that's great. I'm not working with people that are interested in paying their light bill, because this is not the market that you want to trade in to pay your light bill. This is a market with life-changing results if you get it right, and you don't have to risk anything. You're going to lose, but you're going to have the skills in order to make that up. I could very well lose right now 40% of my account, and I'd still have a 50% gain for the year. I'd still have a 50% gain for the year, okay? So I've done really well. on my trading. And I started out at the beginning of the year trading 3 lots, 3 full lots. Then I moved up very quickly to trading 3 and 6. I jumped 6 to 8, 8 to 10, and then I jumped to 15 and 20, and now I've traded, I'm in that stage of acclimating myself to the 20-25 lot position. That's not all the money I have in my account, but it's all the money that I'm putting at risk as I establish a new profit level so that I can go up in risk management into the higher lot sizes beyond that. My goal is not to pay the light bill, so I'm not worried about loss. When I was trading 3 lots at the beginning of the year, the risk management was quite different. I was trading very conservatively. My risk management was right under control, and I was doing great. And that was 2021 when I was trading that the 3 lots, and then I continued that into 2022, and then immediately picked up trading 3 and 6. But in 2021, I was trading that those 3 full lot positions, trading between 1 and 3 full lots. Rigorous risk management, rigorous attention to detail, following the trading plan, and hadn't quite worked out all the mechanics of it, but I had built up enough money that, excuse me, I lost 30% on a couple of my trades, but I still ended the year 31% net profit against risk. So I did take a relatively large hit. I could have made 60%. I could have been a contender. But see, that's not the point of the thing. The point of the thing is, I was at 60% up on that account, and I made a couple of errors, and I lost a lot of money. But that's okay, because people don't make 30% on their accounts. I made 30%. Find people that are making 30% on their account. You have to be really good. You know, I spent 40 years in real estate, and that's a good way to really make a lot of money. You can also lose it all very quickly as well. But I think I made 20 or 25% on average a year on my risk, on the down payments as it escalated up. So to make 30% in something as potentially risky or volatile as the currency markets is outstanding. So I'm very proud of that. And because I lost that much money, it got my attention. It wasn't just a bunch of pips. It was money. And so I learned from that and moved into 2022, and I'm 90% up against risk as of the end of October. So I'm just advising you, as you're beginning in your 4 to low 5-figure account sizes, to whoever you're listening to for your guidance or courses that you're taking or whatever, be sure that you're looking at how they're teaching you and whether they're preparing you for the work that's going to come. It's not sufficient that you just learn what a pip is and how to size your account and a Bollinger Band, and this is the Golden Cross, and this is how you trade, and here's the engulfing candle pattern, and good luck to you if that's what your courses are working with you on and teaching you. Maybe you'll make the light bill money doing that, but the risk is very high if you increase your lot size. If all you're going to do is stay and trade and get to the point where you're trading 1 full lot or maybe 2 full lots, that's fine. That's all the education you need. You don't need to pay me a lot of money to teach you how to trade, to pay your light bill. You don't. You're wasting your time and your money. I'm trying to work with people who eventually someday will have an account size that could replace their job income. That's what I'm teaching. I've made more money this year than I ever made working my software engineering career, in my software engineering career, even at the end of my career, where I was making 6 figures. So I know a little bit about replacing job income. If you're a high income earner, you may not be able to quite have the bank size large enough to replace that job income. But if you could make $50,000 or $60,000 a year, that'd be pretty good, wouldn't it? Well, let's not talk about $50,000 or $60,000. Let's talk about making a 40% return on your risk. Why can't you do that? You can't do that in real estate. For someone to be able to make $50 more a month, that's life-changing. And so your risk management has to be done differently for that case. And I'm certainly willing to work with that person, but a lot of times there's a lot of fear and hesitancy, and so it takes a lot more time to work with that person because they have so much fear of the past. Where if you're 21 to 34, you're going to look ahead and you're going to say, I need more than $800 a month. I need more than $2,000 a month. 40 years from now, you're going to need $7,000 or $8,000 a month, just to be equivalent to $1,000 a month today. And so you realize that, and so you're willing to do that work, and you take those risks. So when I talk with someone, what are your goals? What are you trying to do? Well, how much money do you want? Do you feel that you need to make in order to validate the work it's going to take to learn this stuff, and how much you're going to have to pay to learn it? If you're looking to replace your pay your light bill or pay your mortgage, then you can buy a $500 course and learn this stuff, and everything is going to be okay. But just be aware that more often than not, those skills are not going to prepare you for much more than that. If in fact they can even give you the ability to make that light bill because of the crazy shit that's out there. Be very aware when you sit down to think about this concept of risk management. Where do you ultimately want to get to so that your trading plan in this wonderful, wonderful currency market can be consistent with what your goals and your needs are. You may have a goal or a want to replace your job income, but your needs might be just for another $1,000 a month or $500 a month. And so you need to figure that out so that your risk management matches what your ultimate goal will be. You have to do that right up front. You have to learn that up front, because otherwise you won't be prepared when you have the opportunity to make those jumps. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.